computer. And good morning, everyone. Welcome to First Friday 401k for Friday, July 10th. Yes, I am aware that it is not the first Friday, but if I had held it on July 3rd, I think I probably would have been in a Zoom room by myself. Before I'm allowed to say anything regarding First Friday 401k, I am Timothy Yee, a registered principal offering security and advisory services through Independent Financial Group LLC, IFG, a registered broker-dealer and investment advisor. Member FINRA, SIPC, Green Retirement, Parnassus, and IFG are unaffiliated entities. While we are mentioning specific investments for the purpose of this discussion, we are not making any recommendations or telling you to do anything. Past performance is no guarantee of future results. Phew, there we got that out of our systems. What can I say? Always good to have a disclosure in the morning. And now we can turn to the heart of the matter. So Clyde the mountain lion, along with Jack the Georgetown bulldog and Oski the bear, walk into a stadium and, oh, wait a minute. That's next month. Doggone it. Yeah, I'm already into college football time. What can I say, folks? Very much looking forward to it. But welcome, Ken. Ken is the Associate Director of Research at Parnassus, aided, and thank you, Marie, for setting this up. Really appreciate it. But we're not here to talk about college football, though I think Georgetown would be a good topic, and certainly Colorado Springs, University of Colorado is a fine topic. Ken, why don't you tell us a little bit about you, your role at Parnassus, before we dive into all things IPO?
Yeah, absolutely, Timothy, and thank you for having me, and thank you everyone for joining today. It's a pleasure to be here. So, as stated, I'm our associate director of research at Parnassus. That means I drive our research process. I'm deep in our investment process with our team. I'm deep in upholding and growing our philosophy and really furthering our mission, which is principles and performance, which is putting our clients first and driving returns for them.
Yeah, and folks, you probably are recognizing the Parnassus name. Again, you can see it off of Ken's right shoulder there, Parnassus Investments. This is a company that is in pretty much all of my retirement plans. I will be honest in saying that I talk incessantly about the defendable, repeatable process that the DOL mandates, and that Parnassus Value Equity repeatedly does well. I'm not saying it will do well in the future, but it is a core tenet of many of my retirement plans, and it is a prime example of what we're going to be talking about today as we dive into the world of IPOs. You know, there's been a fair amount of attention, I dare say even buzz, Ken, regarding SpaceX, OpenAI, Anthropic. Can you tell us what is an IPO? What's all the hubbub about?
Yeah, certainly happy to. So IPO, initial public offering, it's simple as the name says. It's the first time that a company's shares are offered to the general public. So
Okay.
what typically happens, a company decides to raise capital. That can be new capital
Mhm.
from the public. That can be selling existing shares of the company to the public. And with that, they choose an exchange to list on. They choose a ticker. There's a couple more nuanced pieces in the process, but you see the outcome. A lot of hype built up. You know, day one, there are usually a lot of people on the exchange ringing the bell, cheering, clapping. The stock starts trading. It trades a lot. It moves a lot, and a lot of news around it. Um, Now, why the buzz about SpaceX? Well,
Hmm.
plenty of people know the company. Plenty of people know the founder, Elon Musk. And there's a little bit more to that, though. The This IPO raised three times as much as the previously largest IPO in history.
Wow.
So the two before this, Saudi Aramco went public a couple years back. Alibaba, who many know is a large e-commerce player in China,
Hmm.
uh, was the other large one. These both raised about 25 billion. A lot of money in and of itself. SpaceX we know raised over 75 billion in its initial public offering.
Wow.
To put some context around the valuation of SpaceX, at IPO, about $1.8 trillion for the full company to be valued at. There are fewer than 15 companies in the world with over $1 trillion valuation.
Hmm.
12 are public, 3 SpaceX, Anthropic, OpenAI, depending on what you think the current valuation is, are the other ones. But to put it in context around the buzz, more money raised than any other IPO in history, one of the largest companies in the world becoming available to the public for the first time in history. And, we see the results, which is a lot of people are talking about it, including us today.
Yeah, and to that end, what I was understanding some of the buzz is that people are going to automatically see it in their retirement plans, whether they want it or not. And this seemed to be based upon the idea that many retirement plans have index funds. So, if you could, for our audience, explain what an index fund is. Does an index fund automatically have to include SpaceX, which I hate the pun, but just launched its IPO? And I understand OpenAI and Anthropic are later this year, maybe. Again, who the heck knows in our world? Nothing is guaranteed till it happens.
Yeah, certainly. So an index fund is simply an investment fund that tracks a certain index. So I'll name some that listeners may know well.
Mhm.
S&P 500,
Okay.
one of the most popular indices in the world. NASDAQ 100 is another very popular one, typically leans more toward tech companies. Uh,
Mhm.
FTSE Russell, another really popular one as well. So then the question becomes, you know, listeners knowing what may or may not fall into their retirement accounts immediately. So of the 3 I just named, 2 of them decided to include SpaceX almost immediately. And this is a big deviation from how IPOs were typically treated in the past, where normally a company won't be added to an index so closely after coming public for a variety of reasons that we can talk through. But what listeners may not know here is a couple of these index providers added SpaceX on not day one, but within the
It's
first
day
few
15,
weeks.
as I
Yeah,
recall, the 15th trading day. What do you
very
attribute that to, Ken? What I thought an index had to follow rules. This is how it's done. Thank you. Have a nice day. It's the definition of passive. You don't get a say.
well. What as a passive investor, what these index funds do, they track the index. So
Ah,
whatever is in the index will go into the index fund. Now that begs the question of, well, what determines what's in the index? These are for-profit corporate entities that decide
mhm.
what's in the index. And how do they make that decision?
Oh,
It's a variety of factors. One of those factors is we want to be the most popular index out there. So more people use our index and they pay us money, revenue, to use our data and use our indices. So that is one of a number of drivers of decision of what we may or may not want to include in our index as an index provider. And if us, you, the end client, own an index fund, and the index provider decides to change its rules, then you end up with some investments you may or may not want in your retirement account.
okay. But in fairness, because I do believe in stating the truth and keeping things on the straight and narrow, the amount that somebody may see of SpaceX in their portfolio, even if they were in 100% S&P index, would I be correct in saying SpaceX, since that is the only IPO currently out there of the 3, would I be correct in saying it is a small smidgen of the account? Is that reasonable?
Absolutely. And in your example, actually, the S&P 500 does not include SpaceX. So of the 3,
Okay.
it's actually the one who decided no. So yeah, like if you
All
have
right, the
a
NASDAQ
S&P,
100. How about that?
yeah, NASDAQ 100 included SpaceX, but again,
Okay.
without going into the nitty-gritty
Yeah, we
details,
don't need
it's
to.
a small amount. Rose, I think you had a question. So I want
Yes.
to.
And Ken Rose
Yes,
always
thanks.
has the best questions, so I'll fall silent.
Uh, Ken, you mentioned that the index funds could change their investing rules, but isn't there like a regulation where they have to notify their participants? I'm um, I'm just on the lookout for those of our participants who, might have partners who are not who don't have retirement plans under us, and whose retirement plans might have index funds, and if they do not want to have investments in SpaceX, that they might not know that their index funds that they're in have changed rules. So, how easy is it for an index fund to just change a rule and allow SpaceX investment to be, or SpaceX holding rather, to be part of the index?
I I do believe that, if an indice is going to change its methodology, it does have to alert others or a variety of parties. I won't speak out of turn here. I'm not intimately familiar with the ins and outs of the regulatory rules around indices, so it makes logical sense, but I don't want to say for sure or not. In this case, the a few of the index providers changed their rules around IPOs, particularly large IPOs, um, and that allowed SpaceX to get in the index.
It's
Okay,
interesting.
so that's
Oh, go ahead,
something
Ray.
to that's good. It's something for our participants or their partners or spouses to make sure that they are on the lookout for changes like these, and it really does bring to mind the importance of really knowing what it is that you hold, and not just being complacent and say that we have this and that, because rules could change, and we you just need to make sure that you are looking at your investments with a critical eye.
Absolutely. Absolutely, and knowing what you own and trusting the methodology that gets to what you actually own in your portfolio. And I'd put a pin in that one for now because I think we're certainly going to come back to it later in the call.
Yeah, I definitely think it is worth revisiting. Just including something blindly because it's in an index, it sort of begs the question of, does it make sense? Is this the right thing? And we'll talk a little bit about valuations and the Parnassus philosophy around that. But it also reminds me of what James told me when he was in the first grade. Follow the money, Dad, and you'll figure out why decisions are made. I'm like, wow, I'm a first grader. That's pretty enlightened, I dare say. But Ken, it sort of makes me wonder about what it reveals about passive investing, that rules can be changed, and I want people to use my index. It sort of seems, at least to my layman's point of view, to hit to what James was talking about. Follow the money. Is that, am I on the right track about what we're seeing maybe about passive investing, that there's an active hand in it?
Yeah, it's a very interesting question, and it's a very interesting debate. So what the way the follow the money works is a person puts money into and let's say an ETF that tracks an index, and
Hmm.
that ETF immediately buys every stock in that index at a certain weight, based
Okay.
on what the current index constituents are. Now,
Mm.
let's talk about what that's blind to. That's blind to what the actual constituents are in the index. That's blind to fundamental characteristics of the companies in the index. That's
Hmm.
importantly blind to the valuation that you pay for said companies. And it's blind, which is of course very important to us at Parnassus. It's blind to the sustainability and stewardship profile of said companies as well. So the interesting part around it, one of the interesting pieces is not only is the index tracker going to be blind to that, but
Hmm.
also there's real money behind this stuff. And when by real money,
Yeah.
I mean trillions of dollars.
Hmm.
And you see that element at play. If you look at data around when the S&P 500 changes which companies are included or not included, the stocks really move on that news alone.
I
And
gotcha.
the stocks aren't moving because they put out a good earnings report or because they hired a new top tier CEO
Hmm.
or because they're gaining market share in their industry or coming out with new products. These stocks are simply moving because a lot of these index trackers, if a new company comes into the index,
Hmm.
all of these index tracking funds have to immediately buy that company, regardless of the valuation, regardless of the fundamental characteristics. And of course, Parnassus, as active managers, we take a very different approach to that.
Yeah, I go back to 2008, where there was a lovely article from Barron's likening the passive versus active debate to the Hatfields and McCoys. And the Barron's article said, "We have finally solved it." And here we are some 18 years later, and the debate continues. So, respectfully, nothing has been solved. And there are proponents of passive investing, which, again, as Ken has described it, is holding an index of companies and holding on for dear life through the ups and downs of the market cycle. Active simply says, let's take a look at the companies in the index and try to figure out which ones we feel, based upon data, may do well. No guarantee, as I already recited the disclosure 3 times, past performance is no guarantee of future results. But I must say, Ken, it does remind me of when my mom was walking our first dog, and we came back from a vacation and mom was all banged up and skinned. I'm like, Mom, what happened? She was holding on to the dog's leash. The dog bolted after a squirrel, and mom held on for dear life, in the turn getting banged up knees, nose, etc. And I'm like, Mom, if you had let go of the leash, the dog probably would have stopped and just barked at the squirrel. But no, mom clung on for dear life. Sometimes there is a time to evaluate your stock position or bond position and say, is it a good time to hold on or let go? And I often liken that to active management, but just my
Really.
2 cents.
Well, and interestingly, Timothy, passive investing or buying a fund that tracks an index, part of the original premise was, well, there are plenty of active managers out there,
Hmm.
and active managers do the job of kicking the tires on these companies, engaging
Yeah.
with these companies, making sure valuation is in line, and really taking out the doing the price discovery, finding
Okay.
good deals out there, finding companies that are undervalued, finding
Uh-huh.
companies that are overvalued, and that if active managers are all doing their job, passive will work well, just building off of the momentum and the great work that active managers do. What we've seen is that passive is getting so big that passive is driving stock performance a lot more than active managers are in many cases. So it's almost been turned on its head where while you'd hope a well, healthy, functioning market
Hmm.
would have enough price discovery in there and have
Hmm.
enough opportunity for active participants to find the good deals, get out of the bad deals, and build portfolios around that. More and more, the some of the performance is being driven by these flows into funds that just track the index and buy whatever the current index weights are. And it's a very interesting phenomenon. It's taken place, of course, over many years, but you see some of these volatile days
Yeah.
when the price movements one way or another don't seem to quite make sense, and that's one of the factors behind it.
Yeah, it's interesting, Ken. Going back to my business days, I was told, you could evaluate a company. I think Black-Scholes was big back then, and we had to do it by hand and work out our company valuations. And we were taught that factually you can see which company is good, is bad relative to its value, and make decisions. And what you're saying is that company fundamentals are being overridden simply by market flows. And so a company's increase in stock price may not actually be correlated to, as you said, hiring a CEO, having a good earnings report, or coming up with a new widget that everybody wants.
Yeah.
That's That is interesting. Ken, as we had talked offline, a lot of what we do here at Green Retirement is focus in on retirement plans. We advise about 100 of them across the United States. What would you say for plan sponsors, plan participants? How should they think about this? And more importantly, what do you think the investment committees and plan sponsors should be thinking about as they evaluate and do due diligence on passive options? And what more should they be considering about index methodology, given that for many of them, this is not their wheelhouse?
Absolutely. I think a key thing to remember is that when we use the term passive, it refers to a product feature. It's not a conclusion on your diligence. Uh, Diligence simply
Ah,
can't conclude, let's go passive and end it there. Some of these nuances with SpaceX really shed light on the fact that diligence, even in the passive sense, may come down to understanding why SpaceX is in the Nasdaq 100 and why it's not in the S&P 500. It may come down to really understanding what those indices entail and what sort of exposures you're getting there. Um, so there's certainly a decision on active versus passive, but even within passive, it's really important to know what you own and know what's in there. I think we have two questions, so we'll start with Rose and then we'll go to Nick.
mhm.
Yeah, just a clarification for some of our participants who might not be as familiar with the Nasdaq and S&P and what's the difference between the two.
Yeah, certainly. So, let's look at Nasdaq 100 versus S&P 500. So, S&P 500 is going to be, the representative of the 500 largest companies in the US. And again, I say representative because it's not always perfect. There is art and science here, and there of course is a committee at S&P that's deciding periodically what's gets added and deleted from said benchmark. Nasdaq 100 is going to be the largest 100 companies traded on the Nasdaq index or the Nasdaq exchange, excuse me. Those are going to be more tech leaning. That's typically where Nasdaq as an exchange has leaned in the past. So it's more concentrated, of course, 100 companies versus 500. It's more sector leaning, again, very tech heavy. And again, you have two different bodies making decisions. S&P as an organization on one hand making decisions about the S&P 500 and Nasdaq on the other hand, another publicly traded company in and of itself, making decisions there.
Makes sense. Makes sense. Again, so the
So
idea of passive is that it is not necessarily as it may be portrayed, just simply blind box. There are influences that come to bear.
yeah, absolutely. Nick, I certainly want you to give an opportunity to speak. Maybe give us a little bit more intel on your question, and then I can share some insights.
Yeah, thank you. Really appreciate your time today. Um, well, as Timothy and Rose mentioned, we work with their team on creating fossil-free 401k options. Along with that, we're also model managers for SMA accounts, and I work on the climate solutions investment strategy. So in our process, we're actively in the rebalance period right now, and we're considering new additions to this climate solutions investment strategy. And as I'm considering new companies, I just wanted to kind of compare with your methodology a little bit on what your leading indicators you're considering. Are you primarily focused on fundamentals? It probably depends on the strategy that you're working on. Is it market opportunity, or is it kind of led by a specific theme for a strategy? So if I'm working on this climate solutions investment strategy, I'm using a filter for, is this company reducing carbon or providing their clients to reduce their emissions, or are they reducing their scope 3 emissions or sequestering carbon or providing renewable energy? So it's a little bit sector specific or specific to the products and services. But I wanted to hear from you and understand kind of what your selection process looks like. I'm sure it varies, but at a high level, if there's anything you could share that might be inspiring or exciting.
Certainly. Great question. So at Parnassus, our philosophy centers on four key pillars. That's moat or competitive advantages, relevancy, which is looking for companies with increasingly relevant products and services, management, quality of the team running the company, and sustainability. Sustainability and stewardship, where again, climate's going to go under, but also a number of factors. Governance is going under there, social factors are going under there, the company's culture is under that pillar. And we consider all of these together in selecting the securities that make up our portfolios. Our portfolios are quite concentrated, about 40 stocks on average in each. If you compare that to, the benchmarks where measured against, our benchmarks probably have anywhere from 300 to 700 companies in them. We are very concentrated, and we choose 40 based on those criteria. But to answer your question more directly on what factors in, it's a variety of these factors. We're really trying to build a mosaic, consider our core pillars, all together in making good investment decisions. And then there's another piece of it, which is portfolio construction and portfolio management, building in a portfolio that performs well in both up markets and down markets, being well diversified across different sectors, across different themes, across different criteria. And really, building portfolios that we believe are going to weather the storm in down markets, keep up in up markets, and really deliver our clients a really good experience over the long term.
No, Ken, it's interesting, and I'm going to deviate just a little with your permission. When you mentioned relevance and sustainability, and Nick, if you have a follow-on question, please let me know because I want to make sure you get the opportunity to talk with a CFA. It's like, woo! Um, I was thinking about the relevance of AI, and yes, I did see the article about the Brown professor who forced his final exam to be in person, and amazing how many people suddenly dropped out of the class and scores fell on the final exam. But AI seems to be quite relevant in today's day and age. Yet at the same time, I was reading Marion from Parnassus, and she wrote an excellent piece on ethics in AI and how does AI develop trust, or can it? And I'm actually going to pop the article into the chat. And then we could even get into a little bit on data centers and sustainability. So, how do those four factors play together? I want to be the best at data centers and AI, so I'm going to increase my moat by investing in data centers. It's relevant because everyone's using it. Let's not look too much about it. Sustainability. How do you weigh all that together, Ken?
Yeah, it's a great question, and it's there's a lot of art around this as well as science. And again, that's why there are four pillars. So you take AI as example, you take NVIDIA as an example, like the company's widening their moat, increasingly relevant product and services, like that's a given. They're fully sold out for years. Nobody can get enough of this stuff. But that sustainability and stewardship pillar is very important and very key to us. Remember, Parnassus, principles, and performance. And how that's working for us is we're engaging NVIDIA on building AI responsibly. We're engaging the companies that are using AI on using AI responsibly, on building the right practices, building the right principles, putting the right policies in place to make sure this is done in a way where our society evolves the right way around AI instead of the wrong way. And us as active managers, us as active investors, like this is one of our key responsibilities. We are the ones looking at what these companies are doing. We are the ones engaging them, and we're doing so. Again, NVIDIA, incredible company, and they also want to hear from their shareholders. They want to hear from their shareholders that represent all stakeholders in the community about how they can be better and how they can be smarter and build a better future. And we're helping in that process. And you see with these pillars, it's a company can have an incredible mode, an incredible relevancy, and be doing great things in sustainability and stewardship front. And we can also help them do better. And we make it part of our mission to do just that.
And that's something I want to hit on, Ken. Would I be fair in saying that passive managers do not engage in that kind of method that Parnassus is doing, that literally having a conversation with somebody where you own a large stake and saying, I'd like to talk to you about these things? Is that something typically you would not see in a passive manager?
Never. So,
Okay.
a passive manager, if I benchmark to the S&P 500,
Hmm.
5 new companies get added, I buy those. If the S&P 500 owns a certain company at a 5% weight, I too will have a 5% weight. There, there isn't fundamental work done. So
So there's no
people like us do the
consideration
fundamental
of
work.
damage. Yeah, no consideration of potential damage to environment or business practices, governance, all the things we hold near and dear, we just buy it and roll.
Yeah, they'll buy it and roll with it, and we'll take a
Hmm.
very close look at a lot of things. And there's a lot of things that we pass on. Um,
Makes sense.
Sometimes it's for mode reasons or relevancy reasons or management reasons. And other times it's for sustainability and stewardship reasons.
Well, let's talk about that, Ken, because I saw an excellent article from Parnassus, and if I may paraphrase it, it said that at this time, Parnassus is not considering SpaceX in its portfolios, not to say it may not in the future, but is that a key in sustainable investment managements?
Yeah. Well, we can use SpaceX as an example. And in our consideration, a few things stood out to us.
Hmm.
Governance, first and foremost, the governance structure of this company that gives its founder and CEO an inordinate amount of voting power and control is typically a yellow flag for us.
Okay.
The companies, you can argue the relevancies there certainly, but you look at the losses this company is incurring, the money they're burning,
Hmm.
and the future that looks quite uncertain. That's another one to consider. Another really very important one for us with SpaceX is valuation. Um,
Mhm.
you know, this company is valued at almost $2 trillion. They're losing money, so they have yet to turn a profit. They're also doing, I think, set to do about 40 billion in sales this year. On
Uh-huh.
on one hand, Elon Musk has teased the idea that this company could do $1 trillion in sales in 2030. That would be pretty phenomenal growth. On the other hand, it's our job as investors to really assess the credibility of forecasts like that. And our job to come to our own conclusions and build our own forecasts and come to our own valuation conclusion about what SpaceX should actually be worth or should actually be valued at today. And again, you can see how a variety of criteria under our 4 pillars uh, leads us to the conclusion that uh, no, we did not participate in the IPO, and no, we don't own SpaceX.
And again,
Hey, Ken.
I put the publicly available article from Parnassus. The CIO Todd weighed in with an article, and I have put that in the chat for all to consider. Again, it's not to say what the future may look like, but at the current time, that's where thinking is. Um,
And I want to highlight too here, Timothy, that
yeah,
things change. Markets move
yeah,
every day. Companies make
right.
changes every day. The companies they're living, breathing organisms.
Yeah,
And
they're
if
not
we woke up
static.
tomorrow and SpaceX was a much more friendly company to minority shareholders, gave them more rights, more control, more ability to voice their views, if the company was trading at a very reasonable valuation, we would reconsider. And we're
Mhm.
reconsidering every day.
Yeah, yeah. I remember the Michael Douglas Wall Street film way back in the 80s, and the elderly woman getting up at the shareholder meeting, and she owned a few shares of whatever company it was. And she had some questions that she wanted to ask, and she stood there at the microphone and said her piece. And as I remember, the people on whether it was leadership or the board, I don't remember the scene, but they had to answer the shareholder. And what I'm hearing in SpaceX, at least, again, I don't know about OpenAI or Anthropic, it sounds like you're saying at the very least we're seeing a lack of ability for shareholder advocacy or somebody to stand up and speak their mind and get an honest answer, perhaps.
Yeah, we consider every company, and as you can probably tell from my description so far, very detailed analysis, very in-depth
Yeah.
diligence, and we use that to come to conclusions about where the company stands today, how it might evolve over the next 3 to 5 years. And again, we use engagement as a very key tool to what we do.
Mm-hmm.
That we do believe in our voice, our ability to influence change at these companies, that change influencing how these companies operate in society and across the world. And we see that as that's representing our clients, that's representing our shareholders, and it's something that's very near and dear to what we do.
Yeah,
Can
and
I learn a little bit more about your sustainability review? Like, are you most focused on operational metrics or avoided emissions? Can you share, or is it more on the governance that you had mentioned?
It's it may not be well, it's very dependent on the company.
Mhm.
So if you're looking at a very highly emitting company, we own some waste companies, for example, very high emissions sort of business, especially for a manager like us at Parnassus. The climate's going to be incredibly important to that sustainability and stewardship analysis. But you compare that to, let's say, a tech company. Tech companies typically not going to emit all that much. But for a tech company, the social dynamics may be a lot more important. The governance structure may be a lot more important, as a lot of them were private at one point in time, and uh, at times can build very board management favorable policies. So we consider all the criteria, but what's most important to us and what we're going to dig into the most varies on the type of business it is, the type of company it is, and at times also what we see as the most pertinent issues we need to engage on. Sometimes it's not uncommon that in our diligence we'll learn a couple things that we really want to follow up on. That's really important for us to get answers from the company on, and we'll engage the company on those things. But it's going to vary company by company, sector by sector, and really one diligence effort at a time.
Okay, so the materiality.
Yeah,
but as you talk about climate and governance, and I want to bring this back around to our 401k participants, these aren't just theoretical things we're talking about. They could impact the performance. And if we're impacting the performance of a stock, and we have many stocks in a mutual fund, conceivably a plan participant might see their balance go down. So that's there's relevance in looking at these issues. Again, if somebody is polluting, and maybe if we're looking at a prior administration where they were very focused on pollution and climate, a company might get a fine, for example, which could impact its performance. Are there specific things you look for in terms of your sustainability practices, Ken? I mean, is it
yeah,
simple as scope one, scope two, scope three, or you go beyond the published reports and really dig in, don't you?
absolutely. Perhaps I can give an example. This to your point about we really want to look at materiality. If there are issues that arise at these companies related to sustainability and stewardship, it can certainly impact the performance of the company, the price of the stock, and ultimately the returns for our clients. So, two examples I'll give of a company we do own and a company we decided not to own. Amazon's one we own. We've engaged with them extensively on worker safety, on workers' rights, and on creating a good workplace for their employees, which we know there are many, very, very many warehouse workers, not only across the country, but across the world. And we have been quite impressed and continue to be impressed the progress that Amazon continues to make and our ability to have very productive conversations with them, and Amazon put new things in practice that truly make it a better company from a sustainability and stewardship perspective. And actually, we also see that influencing their fundamentals as well. The easy example here is if I, as a company, am able to reduce my worker turnover because workers are happier, they're more satisfied, they're treated better, thus they stay longer, that actually is a cost savings to me. And there are instances where I, as the CEO of a company, could actually spend more, pay employees more, but still end up saving money simply because fewer employees leave. So that's Amazon on one hand. There's another company that is US listed, US traded, and in some of our benchmarks, a Korean e-commerce company called Coupang. And when we looked at Coupang, we compared it to Amazon and we said, well, a lot of the great things we've seen Amazon do with respect to their workers, we don't see at Coupang. We don't see the disclosures that would help us really do the diligence we need. We saw some other areas that they seem to be lacking on in terms of policies, procedures, disclosures, and we engaged them with it. And we came away from the engagement continually concerned. It's not a company we own. We decided to pass for the time being, keep the conversation going in the future. And it just so happened that a couple months after we did our initial look, the company reported a significant data breach. Tons of customer information hacked. Many customers left temporarily. The company took a huge fundamental hit, and the stock price fell with it. And that's a great example of we were looking in a variety of areas, but it looked clear to us that as far as sustainability and stewardship went, Coupang was not meeting the standards that Amazon was. And it just so happened that later into that, you saw sort of a result of maybe overlooking certain things or not focused on certain things enough, and that impacting the fundamentals of the business.
It's interesting, Ken. I wanted to loop back to your, and I'll ask this question and then Rose has got one. I wanted to ask a little bit more about Amazon stewardship and engagement. Certainly, I'm all for workers' rights, and I seem to recall that the Value Equity Fund was at one point referred to as something like Great Places to Work. That used to be the name of the fund or something along those lines. But is there
We have a great place to work investment strategy. Maybe you're confusing that.
No, but I could have sworn Value
We
Equity,
used to.
Nick, had
I think it was called the Workplace Fund.
workplace fund, yeah, and it was based on the Great Places to Work survey and CEOs who treat their employees right. And is there a way to actually point, though, at a stock and say, these effective practices we feel have added this much to the performance? Or in the case of Coupang from Korea, it seems to have detracted.
It can be hard to quantify at times. The companies try to do what they can to quantify it. And again, we're incorporating it into a comprehensive analysis that looks at a lot of different things. But if you look at Amazon, for an example, like they do disclose injury rate in their warehouses. They do disclose worker turnover. They do disclose worker policies. And we can monitor that over time and actually see that improve. And that has twofold. It may not be a perfectly quantifiable number, but it's going to help fundamentals to an extent. And the second part, the reputation, it helps a lot. And the valuation multiples these companies trade at, part of it is on reputation. It's not pure, this is a great company, so we're going to value it higher. It's more companies with great reputation, if that reputation is analyzed correctly, are probably going to perform better throughout time. And companies where the reputation seems shaky or on ice, they can run into problems more often than the reputable ones. So that factors in on that piece of the puzzle. Rose, what was your question?
So it's in terms of materiality, I understand and appreciate the sustainable measures that the Amazon has put into place and how that has impacted the bottom line and the share price accordingly. But Amazon's reputation in terms of labor rights has been dismal. I understand some of the points that you raised, but then it is because probably of NLRB regulations that are forcing them to make those disclosures, but they have, as has been reported, really cracked down on unionization. So in terms of that, in terms of labor, how does that impact the materiality in terms of active and Parnassus's policies in terms of investing in a company, and what shareholder activism are you doing in that regard?
Yeah, certainly. Amazon's one we continue to engage very actively on a number of topics, and worker safety is certainly one of them. It's one we talk about often. Another one is energy efficiency in their businesses, decarbonizing efforts they're taking. And again, this is on the sustainability and stewardship front. Amazon also has a moat. Amazon also has increasingly relevant products and services. Amazon also has a management team we're quite fond of. And we're looking at a comprehensive view with Amazon and factoring in all of those when we come to decisions about whether or not we want to own in our funds.
But how about the workers' rights? Is that you didn't mention it, but it's for me with a company like Amazon that has I don't know, millions probably of workers, isn't like workers' right to unionize would be a material aspect in terms of how a company operates?
Certainly. And it's certainly something we are discussing in our engagements. It's certainly something we monitor. And we're monitoring that alongside things like injury rates. How often are people getting injured? Things like sick time and away time and what those look like. And the constant things the company is doing to improve that aspect. So it's certainly a focus area, Rose, and it's something that's part of our discussions and our engagement. And it's something that's part of the entire mosaic of Amazon as a company.
I would wonder, Ken, on the union side, whether that could conceivably lead to happier workers who feel like their voices are being heard. They're more engaged with the work they do. Conceivably, Amazon could be more profitable, could translate to a higher stock price. So is that sort of the area that, or one of the areas, and why that may be something worth looking at?
Again, it's areas we engage on, it's areas we discuss, and it's areas Amazon's focused on too.
Okay. Well, I guess as I've always said, folks, there is no such thing as a perfect green investment. I remember very much one of my clients taking me to task over plastic bags and grocery stores that used plastic bags. And yeah, there are certain areas that we just can't drill down on or that get too microscopic. But I think we can agree it's a better approach to look at these things and have these discussions than simply blindly follow along. As we head into the finish line, You've shared a little bit about engagement, and I seem to recall, and I may be dating myself, but there was a good while back, McKesson Corporation. As I recall, they're based in San Francisco. I seem to think they were involved in pain medication, opioids specifically, and I believe Parnassus was trying to get them to change the ways, if I may say it, not being an analyst. And ultimately, they didn't. Parnassus, I believe, exited the position. And I think there was even an opioid settlement that McKesson was involved in, some $21 billion, which may have had an impact on the company. I don't know. But is it possible, Ken, that engagement sometimes doesn't work and you have to sort of part as friends? Is that an accurate way of things that may happen in your world, possibly?
Yeah. Back to my earlier comment, these companies are living, breathing organisms, and things change. Things change often. And, using Coupang as the example, we will try to engage. We will try and push for the change that we believe is needed to make this a viable investment for us as Parnassus. Sometimes we don't see that and we don't make the investment. There's other cases too where things do change. Companies go a direction that we feel is not in the best interest of shareholders and long-term value creation. That can be on the sustainability and stewardship front, and at times it is. It can also be on the moat front. It can also be on the relevancy front. It can also be on the management front. And we are monitoring all of those. And yes, do we part ways with companies for any one of those reasons and others? Absolutely. There's also cases where we upgrade the portfolio. This company may be great, and there's another one we don't know that we like better, and we feel that will be better suited to our clients, better suited to us in driving long-term performance, and things can move that way as well.
Well, I appreciate that. Before we head to your final thoughts to our planned participants, any questions from the audience? And Nick, I want to make sure you at HIP have had a chance to talk to Ken on this. Anything?
No, Ken, I really appreciate your time today. Thank you.
Certainly.
Well, Ken, bringing us back around to our original topic of IPOs, SpaceX, OpenAI, and Anthropic, we've sort of touched on index investing and why they own what they own, and as James in the first grade said, why the money can sometimes influence people as to what they own. But I think you've laid out a clear case for active management and what you seek to do in terms of how that means for value creation. What would you say to our audience as a parting thought?
I think we've touched on a lot of the key points, Timothy. It's when you're looking with passive, it's important to know what you own. It's important to know what's in the index that's tracking, and it's important to know that the people behind a passive product, behind a benchmark tracking index, that they are doing the work that active managers are doing. Fundamentally, it's a different product, and what we're doing at Parnassus, we've been doing the same thing for 40 years. We are active stock pickers. We are analyzing companies. We're engaging with those companies. We're really sharpening our pencils on valuation. We're looking at really how well a company is going to do over 3 to 4 years or perhaps even longer, and building very concentrated, very deliberate portfolios out of groups of those companies. And you can see us here, you can see me on the call talking about exactly what we're doing every day. And that's really getting in the weeds and delivering our clients what we think are great portfolios that are going to deliver performance for the long term. And again, do so while considering principles as well.
And I think those principles do weigh in on performance. Again, somebody who is polluting could conceivably be fined, that being the most blatant, obvious externality. Certainly, they could also have a change of heart and say, geez, maybe we're poisoning the community we work in. That's a bad idea, but I won't go so far as to say that. Well, folks, thank you very much for your time. We will be back in August. Again, it won't be the first Friday in August because there's an annual conference I am required to be at for compliance reasons, and I will be there. but it will be the second Friday in August. And look forward to seeing everyone then. Ken, thank you for your time. Marie, really appreciate you setting this up. And to Kelly, who is at Parnassus off in Missoula, thank you to Kelly as well. Folks, take care. Be well.
Thank
Thanks,
you,
Thanks,
Ken.
everyone.
everyone.
Thanks, Marie.
Bye.